It was a crisp autumn morning when Frank and Susan, after decades of hard work, finally embraced their golden years. They envisioned leisurely days, traveling, and enjoying time with grandchildren, secure in the nest egg they'd meticulously built. But 3 months into their long-awaited retirement, a letter arrived, transforming their serene dream into a sudden nightmare. An unexpected tax bill landed on their kitchen table, revealing a startling truth: their retirement income was significantly less than they had calculated. They, like millions of Americans, had fallen into the retirement tax trap, unaware of the hidden levies waiting to snatch their peace of mind. One of the first places retirees encounter this trap is with Social Security benefits. Many assume these benefits are tax-free, but for a vast number of Americans, that's simply not true. If your combined income, known as provisional income, exceeds certain thresholds, a significant portion of your Social Security can be taxed. For a single filer, exceeding $25,000, or for joint filers above $32,000, means up to 50% of your benefits could be taxed. Cross $34,000 as a single filer or $44,000 as a couple, and that figure jumps to a staggering 85%. Next, consider your 401k or traditional IRA. These accounts, often the cornerstone of retirement savings, operate on a tax-deferred model. While you enjoyed tax deductions on contributions and tax-free growth for decades, the government always expects its share. Every dollar withdrawn from these accounts in retirement is taxed as ordinary income, at your marginal tax rate. This means your carefully accumulated nest egg can shrink considerably, sometimes pushing you into a higher tax bracket than you anticipated, just as Frank and Susan discovered with their initial withdrawals. As if taxing withdrawals wasn't enough, the government introduces another layer of complexity: required minimum distributions, or RMDs. Once you reach age 73, you are legally obligated to start withdrawing a certain amount from your traditional IRA, 401k, and other pre-tax retirement accounts, whether you need the money or not. Fail to comply, and the penalty is severe: a 25% excise tax on the amount you should have withdrawn but didn't. This mandate often forces retirees to take distributions that increase their taxable income, potentially impacting other benefits and costs. The chain reaction of taxable income doesn't stop there. Higher income from Social Security, 401k withdrawals, and RMDs can trigger another hidden cost: Medicare's Income-Related Monthly Adjustment Amounts, or IRMAA surcharges. If your Modified Adjusted Gross Income (MAGI) exceeds certain thresholds, your Medicare Part B and Part D premiums can jump significantly. These surcharges are based on your tax return from 2 years prior, meaning a large, unexpected withdrawal in 1 year could lead to substantially higher Medicare costs for years to come. Frank and Susan faced exactly this, seeing their healthcare expenses rise unexpectedly. The fundamental tension in retirement tax planning lies in the choice between tax now and tax later. Traditional pre-tax accounts, like 401k, and IRAs, offer upfront tax deferral but come with a deferred tax liability and RMDs in retirement. Roth accounts, conversely, involve paying taxes on contributions today, but then offer tax-free growth and, crucially, tax-free withdrawals in retirement, with no RMDs for the original owner. Understanding this distinction is paramount for managing your future tax burden and maintaining control over your retirement income, turning potential pitfalls into strategic advantages. Frank and Susan's initial shock stemmed from common, yet avoidable, missteps. Many retirees neglect to create a comprehensive tax plan specific to their retirement years. They fail to understand the nuanced impact of RMDs on their overall tax situation and often underestimate how IRMAA surcharges can inflate their Medicare costs. A significant oversight is the lack of tax diversification, relying too heavily on a single type of retirement account. This concentration in pre-tax accounts sets the stage for a cascade of taxable events, leaving little room to maneuver when tax rates inevitably change or income needs shift. One of the most powerful strategies to mitigate the retirement tax trap is the Roth conversion. This involves moving money from a traditional IRA or 401k into a Roth account, paying the taxes on that conversion now, at your current tax rate. While it means a tax bill today, it effectively vaccinates those funds against future taxation, creating a bucket of tax-free income for retirement. This strategy is particularly potent during lower income years, like early retirement before Social Security or RMDs begin, allowing you to control your taxable income and future tax liabilities strategically. Another critical strategy is carefully planning the order in which you withdraw funds from your various accounts. This tax bucket approach often suggests drawing from taxable accounts first, then tax-deferred accounts like 401(k), and IRAs, and finally, your tax-free Roth accounts. However, a more sophisticated strategy involves a blended approach, strategically pulling from different buckets each year to manage your adjusted gross income, AGI. By controlling your AGI, you can minimize the provisional income for Social Security taxation, avoid higher tax brackets, and even prevent those pesky IRMAA surcharges. For retirees who are charitably inclined, qualified charitable distributions, or QCDs, offer an excellent way to reduce their taxable income, especially when RMDs kick in. If you are 70.5 or older, you can direct up to $105,000 per year directly from your IRA to a qualified charity. This distribution counts towards your RMD requirement, but crucially, it's excluded from your taxable income. This means you satisfy your RMD without increasing your AGI, directly lowering your tax burden and potentially avoiding those IRMAA surcharges, all while supporting causes you care about. It's a true win-win. Avoiding the IRMAA trap requires foresight and active AGI management. Beyond Roth conversions and strategic withdrawals, consider tax loss harvesting in your taxable accounts to offset gains. Timing is crucial. If you anticipate a year with unusually high income, perhaps due to a large Roth conversion, plan carefully to avoid pushing your magi over an IRMAA threshold 2 years later. Remember, IRMAA is based on your income from 2 years prior. Proactive planning, often with the help of a financial advisor, can save you thousands in Medicare premiums, allowing you to allocate those funds to your true retirement priorities. Frank and Susan, after their initial shock, realized the importance of proactive tax planning. By understanding the intricate web of Social Security taxation, 401(k) withdrawals, RMDs, and IRMAA, they began to implement strategies like Roth conversions and strategic withdrawal sequencing. Their experience serves as a crucial reminder: retirement isn't just about saving enough, it's about smart tax management to preserve what you've saved. Don't let hidden taxes erode your hard-earned freedom. Take control of your financial future, plan diligently, and ensure your retirement dream remains the secure, joyful reality you've always envisioned.